In my opinion, buy and hold only works for Wall Street. Here's how I'm building my wealth using something called the options wheel strategy. Yo, what is going on, premium chasers? I hope you are having a God blessed day today. I have a very special giveaway down below. If you drop a comment, everyone down below is going to get my 25 favorite wheel strategy stocks that are all under 25 bucks, perfect for all budgets. So drop a comment down below on today's video for that. And while you're down there, hit that like button and that subscribe button. Guys, today we are talking about how am I personally building my wealth using something called the options wheel strategy. Now, you have probably had terrible experiences buying options, swing trading, day trading, all sorts of weird things. In my opinion, those things are just way too confusing. At least they are for me. I need a strategy that fits into my life, something I don't necessarily need to babysit, something that I don't have to draw on candlesticks or create abstract art. That's just not me, and that's what we're going to be talking about today. So let's go over the shoulder. So here I am in my Moomoo account. Guys, I have a very special offer from Moomoo actually for all of us here. Number one, you can get up to $1,000 in NVIDIA shares. You can get a 3% match on your portfolio transfer. You get an 8% APY cash sweep and a very special one. If you deposit $2,000 into your Moomoo account, you're going to get a free $100. That will be the first link in the description of today's video. So make sure you guys check out Moomoo. You guys already know on the channel, I have been absolutely loving them recently. So make sure you click that first link. But guys, today we're over the shoulder here in Moomoo, and the first thing we're going to be doing is thinking through what stocks do we want to run this strategy on. Listen, at the end of the day, this is a very simple strategy, and I'm going to explain it to high level. We buy stocks or ETFs at prices and dates that we choose, and we collect a premium income upfront from an options buyer. Yes, right? Remember, if you've ever been an options buyer and you're paying money or you're paying a debit, where do you think that money's going? Well, that money is going to the sellers, right? They're going to the option sellers, right? So that's what we're doing. We're saying we're willing to buy 100 shares for a specific price on a specific date, and we set those terms, right? And then the second part of it is we sell 100 shares at a price and date that we choose, right? And we collect a premium income as well from that. Okay. Again, coming from those options buyer, make sure you send them your Christmas cards. Christmas is coming up. Okay. And if anybody wants to join in with me, we are going to be sending them a group, nice gift cards as well. No, all jokes aside, but let's get over to the shoulder here, guys. So let's go over to the options right here. So firstly, me personally, I like to look at this wheel strategy. I like to call it the ARC options strategy because I like to over-engineer it. I over-engineered the wheel strategy for myself. But at the end of the day, if I only could pick one, right? Because a lot of people ask me, Pete, what's the one? If we only could pick one, which one would it be? Me personally, I would pick SPY. Why am I picking SPY? Well, when we look at SPY over the course of let's say the max time, right? SPY has always gone on and hit all-time highs. Past performance is not indicative of future results. We all know that. Right? We know that. No one knows what the stock market is going to do. Absolutely nobody is going to let anybody tell you. But the biggest risk of this strategy is that you get stuck holding stocks. That's how you get burned, right? So there's a lot of people you see here on YouTube. You see them, and they're pumping, they're pumping. They pumping all sorts of stuff, right? The companies that have like terrible financials, like all this sketchy stuff. Why are they doing that? Well, because their premium that they're collecting from saying they're willing to buy 100 shares or sell 100 shares, right? Their premiums are insane. They're through the roof. You're going to see that here in just a moment. You're taking on a lot of risk. There's nothing as free in this space. Nothing is free. In my opinion, the way that I believe, me personally, I can set myself up for success with this strategy is by sticking to good quality companies. And if I really just don't feel it and I don't like individual companies, I'll just bet on America. Because at least I'm kind of diversified here. Because again, the biggest risk is you're stuck holding 100 shares of a stock or hundreds of thousands of shares, right? So for me, guess what? I'm going to sleep better at night holding SPY. I don't know about you, but drop an amen in the comments. Are you not sleeping good at night if you're stuck holding SPY? I don't know. Like me personally, I'm sleeping just fine because for the most part, I do believe personally that SPY will recover and hit all-time highs again, okay? I follow Warren Buffett's rules. Don't lose money. And it's rule number 2. Don't forget rule number 1. Let's go over to the options chain here on SPY here, okay? So here I am just on my options chain of SPY. And what I'm looking at here is the expiration dates. So right here, you could see we have, September 17th, September 18th, and you can go out as far as you want. Me personally, what I like to do with a SPY is I like to run weeklies. Okay, what is a weekly? Well, if I click this, or if I just show you right here, all I'm saying is, and I flipped over to the put right here, all I'm saying is that on September 24th, 7 days from now, I'm willing to buy 100 shares of SPY in 7 days at close. Now, that's the date. Now I get to name my price. Right? So at the time of me recording this, SPY is trading around 660. Okay, so let's say I'm willing to buy it at, let's say, we'll just do our 650, we'll do our 653 here. All right, we'll do 653, right? So that's my strike. I have a put, and I'm selling. I'm not a silly little options buyer no more. And you can have as many contracts as you want. All right, well, you not necessarily. With SPY, sure, but like with other whatever. I'm not going to get in all based on that. But for the most part, you can open as many contracts as you like. So we'll just stick to one. One contract equals 100 shares. That's the way it is. Now, you could see here's our order. You could see we are going to collect a credit here of $319. Not financial advice. Results vary. This is just the premium I saw at the time of me recording this video. Okay. So that's $319 that I would be collecting as a credit. That is actually, in fact, given to us up front. A lot of people, what they like to do is they will factor this into their cost basis. Me personally, I do that sometimes, but not always. So I instead like to kind of just follow my trackers, which I will show you right now. So here is, this is our trade. And I like to just plug everything into my little tracker right here. So I'm collecting $319, right? $319. My collateral here, right? My collateral is 65,300, right? 65,300. Now, how am I getting that number? Well, we're saying we're willing to buy it for 100 shares at $653. So that's locking up 65,300. Now, this is what our premium return is going to be. This is in a 7-day period as well. Okay. So that's 319 divided by our collateral. Okay. Now, of course, you can have multiple contracts. The more contracts you do, obviously, the more premium you're getting, but you will need to wrap up a lot more collateral, right? And obviously, those results will 100% vary, guys. Okay. This is just what I'm seeing at the time of recording this. Let's talk about the risks. They are very important to understand. Okay. Because please don't let anybody ever tell you that there's some risk-free strategy that they've discovered, because they're just trying to pull one over on you. Okay. I'm going to delete this one real quick. Let's say, right, on the 24th at close, right, SPY is trading at sideways. It's just trading at 660. Maybe it's on a bull run still. Your contract expires worthless. Your money is returned back to you, right? And then you could run the play again on a different opportunity. Fantastic, right? The second thing that can happen, and this is the biggest risk of running the cash secured put that I'm showing you, is that, right, let's say it's trading at like 650. Let's say anything under 653 that we chose right here, anything under that 653. If that happens, you are buying it. You are buying at 653. So your money's not going to be returned back to you. Instead, you're going to get 100 shares of stock, right? You're going to get 100 shares of stock with the cost basis of $653. Okay, that's the biggest risk. Now let's still talk about the other side of it, because assignment is something I have found that a lot of people that run this strategy are so afraid of. When, in my opinion, that's a whole side of the wheel that you miss out on, because there's additional gains to be had, right? Actually, more gains to be had on the covered call side. But people are so afraid to actually get assigned, right? So let's talk about it. So right here, what we'll now do, let's just pretend for this example, guys, because it's going to skew the numbers if I don't do it this way. We're just going to assume you went out there and bought 100 shares of SPY for $659. Okay, just keep it that simple. Now what we can do is we're going to sell a call. All right, so I'm going to flip this to call. And let's say you own 100 shares at $659. Most people will do that, right? They'll ask, and literally, I challenge you. Go literally ask anybody in your life that does any sort of investing and ask them, hey, How do you invest? Do you just buy and hold? All of them buy and hold. Nobody does this strategy, okay? Besides like those of us that are tuned into this stuff, right? Nobody does this. That is ludicrous. That is a sitting asset that's literally doing nothing. That is like owning a rental property that just sits there and all you're hoping for is that the property appreciates and you don't fill it with a tenant. I know that's not the technical definitions, but that's the way I explain it to my friends, right? Like I literally will tell them, like, let's say, like, cause again, like, let's say you bought a piece of a property of real estate, right? And of course it, maybe goes up in value a little bit every year, just like your stocks, they go up in value every year. Obviously past, it's just an example and I'm trying to make a point across. All right, guys, right? So it goes up in value a little bit every year. Now, why wouldn't you fill it with a tenant? Like to make more money, right? You know what I'm saying? Like that's what I'm trying. That's the point I'm trying to make across. That's kind of how you can look at this if you really just want to see it kind of like a simple explanation. So let's say we own 100 shares of SPY. Let's put them to work, guys. Let's put them to work. All right. So right here, we own 100 shares and let's say we'll just go out 7 days again. Okay. Now this is where we're saying the price that we'd be willing to sell those shares. Okay. So let's say we're cool selling them at, let's say, our delta here is a 0.30. Delta, so delta is a very simple and easy to use indicator that tells you a rough probability of assignment of your shares getting actually sold here at 665 at close on the 24th, right? So, we have a 0.30 delta, 30% chance of that happening, but a 70% chance of nothing happening. Your shares do not get sold. They get returned back to you, and then you can run the play again on another weekly basis, okay? So for this case, we would actually collect $185 of premium. So again, I have another calculator in here that I can actually put in what my premium will be. So I put 185. My strike of option here, right, is what I'm willing to actually sell those shares for. So I said I'm willing to sell them at 665. Let's say 665, right? And my purchase price we said was 659. Right, our average price. Very much lower premium return, but again, we're only doing that. This is a 7-day trade. I'm going to talk to you guys about doing this stuff on a monthly basis in just a moment. Now, if we end up selling our shares, we'll get a profit on our shares of $600 for a total profit of $785. But let's kind of talk about this real quick, okay? Because we need to understand what is actually possible here and what could actually end up happening here. Okay. Now, obviously, the closer we get to the current market value, like if we were saying we're willing to sell them at 662, you get more premium. You get $297 or $296, right? It's 661, $340. So the closer you play there to the money, right, the higher chance of assignment happens. But for the sake of this example, right, we're saying we're willing to sell them at 665, right? So let's say in 7 days from now, right, this SPY is trading sideways, anything above below 665, right? It's trading at 664, 3, maybe it's had a downturn, whatever. Your shares don't get sold, they get returned back to you, and then you can run the play the following week and collect some more premium, right? The second thing that can happen, and this is the biggest risk of this strategy, is let's say it's trading above. Okay, let's say it's at 670, 680, 700, right? In 7 days, SPY has hit $700. You are on the hook to sell your shares at 665. This kind of essentially caps your upside. Okay, it does. It really does kind of cap your upside. Now, let me show you guys another quick example. Me personally, in my retirement years, I'm going to be doing this, right? Low chance of assignment, low premium return. I'm not touching my principal, and all I'm doing is just collecting, quote unquote, rent checks. That's the way I like to look at it. But for example, let's just type in like another stock that's very popular to sell options on, and that is NVIDIA. Right, so we'll go over to our options chain here on NVIDIA, and we're going to click sell a put. And then what we're going to do here is I'm going to go out about 30 days, right? So let's go 30 days away, because 30 days is a very, very good number to look at as an option seller because time is in our favor. There's less management involved. This is why I'm an option seller, guys. I'm not a day trader. I'm not in here like all day micromanaging stuff. I open my phone, I set my trades, and I'm good to go. Right. So with that said, obviously at the time we're recording this, NVIDIA is trading at 170, right? In 30 days, what do you want to buy it for? Well, let's just let Delta kind of guide us, right? So 0.25 Delta, that's what with individual stocks, I'm usually around that 2.5 to 3 Delta. I like to get assigned here, guys. That's part of the game. So you could see here, look at this. Look at this. And I'm doing this on purpose so you guys can see how much more premium you collect when you're doing individual stocks usually compared to, a quote unquote safer bet like SPY, since it's always in the past hit all-time highs, right? So is Nvidia, but still there's more risk here, right? You're always taking on risk. That you, as an option seller, you are taking on risk, right? So let's just say 160s, right? We're willing to buy 100 shares at $160. We collect $305 of premium. Let's go back to our calculator here, right? Cash secured put calculator. Well, we said $305 of premium, and we're risking $16,000. Now we're doing this over a 30-day period. But look at this. Our premium return now has shot up to nearly 2% compared to what we did 7 days on a SPY. Okay, so you have to understand you do take on a little bit more risk, but then let the North Star, in my opinion, be what stocks do you actually want to enjoy. Don't just go on YouTube to find what people are telling you to do, because that is how you get burned. If you see premiums that are like 3+%, be cautious. Listen, do what you want with your own money. Absolutely. Listen, I'm just sharing what I personally like to do. But when you see premiums at 3, 4, 5, 6, 10%, you got to understand, like, that risk you are taking on is drastic. Because again, the biggest risk of this strategy is, let's say I do get assigned Nvidia here at $160 a share, and it never recovers. It drops down to like $100, and I can't even do covered calls at 170. Like, literally, this is why if you focus on companies that you believe in long term and you genuinely believe in, you've researched, you understand their business model, you have an understanding not just from somebody on YouTube, you're setting yourself a little bit more for success, guys. Again, guys, click that link down below. Check out Moomoo. You got a bunch of bonuses from them, guys, that they're hooking us all up with. 1K. Up to $1,000 in free Nvidia shares, a 3% match on your portfolio transfer. If you deposit just $2,000, they're giving you $100, right? Plus, you're getting an 8% APY cash sweep. You guys already know I love that cash on my collateral as well. So, guys, I hope you have a fantastic rest of your day. Remember, sell options, collect premiums, repeat. I'll see y'all tomorrow.